So one of the important things that we look at in constructing portfolios and allocating assets, which I think is one of the most important things in your investment plan, where your money is what really matters. Had you been in a high growth area with a small piece of your money, it could have made a huge difference on your overall portfolio. Same if you have a large piece of your portfolio in a very poorly performing area. Managing that risk, having an even, more even return to reduce volatility. It's all about how you allocate your assets. One of the things that we really carefully consider that is overall macroeconomics and the world and the way the world works. And I think that is very important in making a portfolio plan. And our firm's view is very much sort of free market oriented, looking at the way that trade works in the world and trying to understand the big picture macro trends about what is going on in the world, how countries are interacting, and these kind of things. We're in a very global economy now, and that's improving as we speak because of the internet, and hopefully digital securities will make it so that stock markets are no longer siloed by country, and you'll have it be a lot easier. Right now it's very difficult for an American to own stocks in other countries or for other countries to own American stocks. Typically people only own in the country that they are in or through funds. That's pretty much the only way that you get investing for almost all investors. And that's kind of crazy in this day and age to not have more accessibility, where you should be able to buy your stock in China just like you can move Bitcoin to China and then over to India and then back to London and back to Chicago. If you could do that with stocks, that would be really cool. What I just described, if it was stocks, is almost impossible under today's technology. And if it was possible, it would certainly take a very, very long time. You'd need all kinds of separate accounts and things like that. Even moving it within the United States, which is much, much easier, can still take many days. So understanding the overall big picture economics is really key. And the good old-fashioned tried and true methods of both macro, looking at countries and what works, and governments and which areas make sense to invest, and then looking at what companies and individual investments, typically stocks, sometimes bonds, that you would make within a country. And then the best way to do that. Typically we do through managers. We wouldn't go into India and try and pick stocks, for example, because I don't know anything about India other than I have a lot of great friends from India and I love the food. So I wouldn't be capable of even beginning to invest in, analyzing the individual stocks. You need an on-the-ground local expert. But the first step is you decide, are you even going to be in India? Are you even going to be in stocks at all? And then you want to look at the macro issues about, is India a good economy or not? When it comes to countries, and this sounds a little cliche, may sound even a little political, generally the evidence that I've seen points to more free economies doing better. It seems maybe overly simplistic. A lot of people might criticize it, but I think it's very true. And if you look at the really, really bad economies, and India actually is an example where they've had a lot of problems with bureaucracy. Bureaucracy tends to slow economies down quite a bit. India's had some growth because of population and demographics and now technology. But in my opinion, they'd be in a much, much better position if they had a more free market system and less bureaucracy. And we can see that in evidence where, all else being equal, generally the better economics, or at least the more free economics, tend to do well. And we've seen that a lot across the board. And typically the catastrophic failures like Somalia, there's an image you can search online. Look at what Somalia looked like before the heavy-handed government, the socialists, basically took it over, and you can see that all over the world. Typically, the more heavy-handed, all else being equal. Now, there's examples of sort of more socialist governments that have done well, but they typically have natural resources, different demographic makeup, different employment, education, all kinds of other factors. Norway has had huge wealth and natural resources for a long, long time. So have a lot of the other Dutch countries, and their economies now lead more socialist. But again, I think all else being equal, the more free examples of those countries tend to do better. When it comes to companies, It's a little easier and it's not so much controversial or political. With companies, it really ends up being about the earnings. What's the company earning and how is it growing? And then there's other things like the company name and the industry and the growth of the industry, expected industry size, all these kind of things. But really, it's just, is the company making any money or not? There was a funny thing when I was early in my career, early 20s. There was a, kind of, I came into the industry just as the last batch of, sort of old school stock jockeys were kind of, being phased out and be replaced with more managed accounts. I was one of the new kids working on managed accounts, which is now what everybody does. And now I'm thinking maybe going back to picking individual stocks might be cool as a model for some advisors and brokers out there. But anyway, early in my career, there was this kind of funny broker, and he was talking to somebody. In the old days, people would pitch stocks on the phone. And this guy's pitching stocks, and he's talking to some other broker, and he said, "Yeah, this thing's great, blah blah blah. The sales are great." And the guy says, "Well, what does this product do?" And the guy said, "I don't care. They're selling them." And I always thought that was hilarious because it's partly true. If you're selling something, it speaks volumes. If you're not, you're not. And all the other nonsense that people put in there. And by the way, with both economics on a macro and sort of individual stock level, there's a lot of smoke and mirrors out there. I recommend the book Skin in the Game, which talks about basically BSers, people in academia and professionals, often consultants and others who have a vested interest in selling you nonsense, want to complexify it. So there's a whole bunch of people who have a vested interest, particularly academia, and real high-end consulting firms. I've worked with consulting firms that charge $30 or $50 million for a report, and the report is often written. A partner is sort of selling the report, but it's actually written by a bunch of junior people who grab their stuff off the internet. So you have a $50 million report that's written by a team of relatively junior employees sometimes, but the concept in No Skin in the Game. Of people without skin in the game is basically they're not sharing in the risk, therefore they're incentivized to kind of complexify things to justify their existence. So there's a whole bunch of people would tell you there's all these complex things and no, revenue doesn't matter. That was the big joke during the dot-com bubble was, oh no, this is new economics. Revenue doesn't matter, eyeballs matter. And then pretty much a couple of years later, people were like, well, no, revenue does matter. Otherwise you're not going to have a company, it won't exist. And the same is true for the macroeconomics. A lot of people would try and micromanage, and these egotistical, political types who would go in and say, I think this thing and that thing. And I could point to countries all over the world where you have technocrats who are monkeying with this. If we just changed this and just changed this and had a trash tax and a special economic zone and this kind of special visa for this, and it never works. Really, just more freedom is what works. The companies drive the economy, entrepreneurs drive the economy, people trying to solve problems. Somebody's thirsty, they sell water on the street. Somebody's hungry, they sell food. Somebody wants more food, they become Domino's or something like that. That's what drives the economy. That's what drives the world, not these micromanaging technocrats. So typically, if the government can get out of the way and let the people who are solving those things, whether it's the person on the street selling water or the person designing a new blockchain or a new AI solution or whatever, let them do their thing. They're going to fail. They're going to make it. They're going to do their own thing. Typically, government doesn't have a great deal of ability to impact that. Otherwise, somebody would have done it already. So there's a couple basic, simple principles, and then we get more complex than that in it. But we do look at those sort of basics to think about your overall economics in your portfolio, because it does inform your asset allocation, and your asset allocation is kind of everything in portfolio management.